It's so hard to predict the markets. But if you believe that there's more upside to rates than downside, meaning that the odds of a rate decrease are much greater than the odds of a rate increase from here, then there is upside to valuations, particularly for growth stocks, also for distressed real estate, because all these things get more valuable when rates are lower.
Well, let's talk about real estate, because I think that's one of the biggest overhangs right now that hasn't fully been accounted for. There's, $3 trillion of commercial real estate loans sitting out on commercial banks' balance sheets in the US today. 3 trillion. It's an insane number. And we were all talking over text the other day, as you guys know, about this building that's being shopped and got some attention on Twitter. I think it's 115 Sansom. You guys know this building? I've lived in San Francisco for how long have I lived there? 20 some odd years now. So I know this building. And it's a 125,000 square foot building that's going to likely be fully vacant in, call it, 2 to 3 years. So the guy puts it up for sale, the equity owner. He puts the building up for sale, and he's basically like running an auction on it. And the brokers are all saying, hey, it's currently at $199 a square foot, which translates to $25 million. It'll probably get done at $300 a square foot, which is about $38 million for the building. The problem is, if you look at the debt on the building, there's $53 million of debt. B of A owns that note. So Bank of America in 2016 issued a $54 million note on this building. If this deal closes at $39 million, the equity owner who's running this auction to sell the building makes $0. All that happens is that money pays down the debt, and the debt only gets 70 cents on the dollar, and B of A has to take a write down on the rest. So there's a rumor that in this particular case, what's happening is the equity owner of the building is putting it up for auction to show the bank, hey, this thing's only worth 70 cents on the dollar for you on your debt. You should restructure my debt. So apparently there have been a lot of building owners that have been going to their banks and saying, hey, I want to restructure my note. I want to have longer payment terms. I want to keep the rates lower for longer. I want to have some of the debt forgiven. Anything they can do to get the cost of the debt down, because the overhang of the debt on all these buildings is so significant. These buildings cannot make money and the owners will never make money. So they're like, why am I even wasting my time? So they have one option, which is to hand the keys back to the bank and say, here you go, you auction it and sell it. Good luck. And the other option is to go to the bank and say, hey, restructure my debt. Let's figure out a deal. Here's the problem. The $3 trillion of debt that we just mentioned that's sitting on all the banks' balance sheets is all being held at par. They're not discounting it at all, and they're not marking it as being impaired in any way. So as soon as they have to start writing this stuff down, the bank's balance sheets all get impaired. And so there's a real risk in the market that I don't think has been fully accounted for, that we're starting to see the cracks. And to Chamath's point, this might accelerate either Fed action, or, as I've mentioned in the past, I think the federal government steps in and starts to issue programs to support commercial real estate developers and owners. Sachs, I know you've been following this quite a bit. Maybe you could share your point of view, and if I'm off on this, in terms of how significant of a problem this is, how much of the $3 trillion of debt really is impaired, and by how much should it be impaired, do we think?
Massively. I think it's a huge problem. If you talk to anybody, any of these commercial real estate developers or sponsors, they'll tell you many of them are just kind of hanging on by their fingernails. I mean, it's really ugly. And you know how distressed things are when you actually look at some of these sales. That same account on Twitter that you posted, he's got like a tweet storm here showing about half a dozen of these sales that have happened in the last few months. And buildings are now selling for $200 to $300 a square foot in San Francisco. These are buildings that could have sold for $1,000 a foot, a couple of years ago. And now they're selling for $200 to $300. The replacement cost, if you're to try and recreate these buildings from scratch, given how expensive it is to build in San Francisco and how complicated the entitlements process is, probably be $1,200 plus a foot. So these buildings are selling for 10 to 20% of their replacement cost. These are fire sales.
If you look at the loans in the San Francisco commercial real estate market, do you think that the loan value is probably impaired by 40%? Because that's roughly what it would say on that 115 Sansom building, is B of A would probably have to take a 30-40% markdown on their debt. Do you think that's the right way to think about the numbers, 30 to 40% of the debts?
You could figure it out this way. A typical commercial real estate deal is about 1/3 equity and 2/3 debt. So if somebody bought a building at, call it $1,000 a foot, they would have had to have put in, call it 333 of equity, 666 of debt. Yep. Now, if that building is only worth, I don't know, 200, 250 a foot, there's $750 of loss per foot, right? And only 333, roughly half of it, is equity. So the debt is taking a huge haircut there too.
Yeah, that's about 40-50%, right?
Yeah, and no one wants to recognize that loss. The equity holders certainly don't, because they get wiped out. And even the banks are reluctant to recognize that loss, because who knows what that could trigger when their balance sheets are so impaired. So what
where
everyone's
are these
trying
people going to come from, Sachs? Where are they? Where, like, this is my big problem with this argument. Is I think that numerically you're right, that there is this bottoming, or there is just like a lot of value to be had, right? The problem is, and I'll give you an example of a company that I own. So it's not even a company that I'm just a minority investor in. We used to be in San Francisco, and we went virtual. Now, all the salaries are pegged to San Francisco salaries, but now everybody's sort of like everywhere throughout the country. We don't have an office space. And I'm really struggling trying to figure out how to actually bring everybody together. And my choices were, I thought, okay, well, let me find what it would cost to actually run this place in San Francisco. And my OpEx would have gone up 15, 20% just for the building. So then I'm like, okay, well, where else can I go? And it's like, well, I could go to a place like Las Vegas and I could put the people there. It's an hour, so it's close by. We can fly there whenever we need to. It's got no tax, so maybe that's an advantage for the employees. And so I'm in this constant hamster wheel as an owner of a business. I can't get people into the office. If I do bring them into the office, it's super expensive and it bloats my OpEx. So I'm just trying to figure out, how does that get resolved for people like me so that we want to go back to San Francisco and rent those buildings that are so cheap?
Those buildings are going to have to get written down first. So I set up my company in 2006, and I was paying $22 a square foot for my first office in 2006. And then we ended up getting a really nice office, and I think we ended up paying like $35 to $40 a square foot by the time we moved to a super nice office around 2010. But around that time, which was also when GFC happened, the global financial crisis in 08, 09, and that's when rates dropped to zero. And that's also when all startups and tech companies said, hey, let's start setting up in San Francisco, because it's mostly young people that are engineers now. They mostly want to live in the city. They mostly want to be single and have a good life here rather than go live in suburban Silicon Valley. And so real estate shot up because rates were zero. All the tech companies were setting up. I mean, Sachs, you had Yammer in San Francisco, didn't you? Were you on the peninsula? Yeah. And that was like the place to have your company, was in the city. And so I would argue, like, if you go back to the 08, 09 era, that's really when San Francisco started to take off. And it was almost like a bit of an outlier of a bubble that started all the way back then. And then, you know, the ZIRP environment kept things moving up and up and up over the years that followed. I do think that this market will likely normalize back to pre-2010, pre-09. And that's when rates were like in the $25 to $35 a square foot range for, you know.
But are you saying that I will move back to that building and I'll move my company back there
when it gets repriced? Yes, I do think so.
Are you sure?
I don't see how the market stays where it is. Yeah.
Chamath's argument is basically on the demand side, basically saying, where is all this demand going to come from?
I think you could give it to me for zero and I wouldn't bring my team back there. I'm just asking, like, again, the math all makes sense on a spreadsheet, but the big issue is, as an owner of a company, why would I ever bring my team back to that place? And I'm struggling even at like...
Oh, you mean because it's a nasty city, because it's all messed up? The city's messed up
First of all, if you're asking me to blow up my OpEx 10, 20%, the answer is absolutely not will I do that. Then if you're saying, well, Chamath, how about at zero? Let's just go to zero, right? It's free. Yeah. Take the building.
Yeah.
I still wouldn't do it, because then these people have to move from all around the country, come back here, and all of a sudden just live in a slimy dungeon. Yeah. So how does that get solved? So that building should be zero.
Sachs, you own buildings in San Francisco. What's your answer as a landlord?
Yeah, I only own buildings in Jackson Square, which is like the one decent part remaining of San Francisco, which is actually where people want to be. And we've seen pretty good leasing activity there, because it's, as people get driven out of Market Street and out of Soma, they substitute to Jackson Square. Look, I think Chamath makes a good point, which is the demand picture for San Francisco is really unclear. There's something like, call it 30% vacancy. So there's an enormous number of these zombie buildings. And it's really hard to understand where the demand is going to come back to fill them.